What is up, guys? It is Fit here from Fit to Trade. Welcome to my channel. My name is Fit. I am a futures day trader, just documenting my journey trading prop firms and eventually personal capital. So I just want to keep this as a record of basically zero to however much we end up going. There's no limit, there's no reference point, which we'll get onto in this episode. I really want to pivot and focus on psychology. A lot of the trading is really variance. It's a 50-50 chance whether you're going to win or not. It's what happens within that period, and especially on the losing side of things, I think determines what makes a consistently profitable trader. So we're going to dive into that. I really want to start a series, so every Wednesday we're going to explore a psychological concept, and we're just going to break it down and see how our human wiring really affects the way that we trade and what we can do to be better traders as a result of that. I have my bachelor's degree in biomedical science. So I have done a bit of psychology in my undergrad. I do have my master's in public health as well. So a holistic view of how this is going to help not only traders, but just you in general day life, I think is really my approach to this and what I hope to get out of doing this series with you guys here. Not just for you guys, but for myself also. So today's topic, we're going to talk about loss aversion, prospect theory, and why prop firm challenges are designed to exploit this. As you can see from the last video, I have blown both of my live accounts, and had I had this information, maybe that process wouldn't have occurred. So let's get straight into it. I want to refer to some peer-reviewed articles. There'll be all the references at the end if you guys want to have a bit of a read as well. But let's dive into the data and the science. So picture this, you're on day 4 of your prop firm challenge, your account is up $3,800. Let's just make it a 50K account equivalent. You take a trade, it stops out, you lose $2,000. You're still up $1,800 on the week, but you don't feel like it. You feel like someone who just lost $200. Why is that? Dive into it. So Kahneman and Tversky ask people a simple question. I'll flip a coin. Tails, $100 is you lose. And then heads is you win a certain amount and you decide how much you want that to be. So they asked a bunch of people and the median mean value was 200 to 250. Crazy. So people were saying we need roughly at least 2x to consider taking this bet. Now, if humans are rational, they would answer 100, 110 even, and that's still profitable. They're just that little bit above a 1R. It's 50-50, but having obviously that amount exceed that leads into two things. One shows that humans are greedy because we want to make sure that we're earning substantially more than what we're losing, which we'll talk about in a second. But it also poses, when you are trading, especially in the prop firm space, are you trading with a minimum of a 2R risk to reward? Now, you might tell yourself a lot of the times I am, but I've known in myself when that irrational side of myself kicks in, I don't focus on risk to reward anymore. I just want to get my losses back. Let's dive into that too. Basically, they came up with a concept called prospect theory, which states that we don't evaluate outcomes based on total wealth. We evaluate them based on gains and losses from a reference point. And we actually feel this asymmetrically. So gains will feel substantially different to losses. Let's chat about that. So reference dependence is the first topic that we want to talk about. Your brain measures outcomes relative to a starting point, not absolute wealth. So a $600 account after starting at 500 feels substantially different to a $600 account after starting at 800. This is actually why I blew my top step account. I was up in the first week at the highest point, $4,000, and I ended the week at 12,000. So I gave away $2,000, but it felt like I had gone at break even or pretty much below my starting balance, because that reference point of holding on to that 14 and the reference of trying to hit these certain targets to release more into my account just changed my psychology. Next is loss aversion. So losses are felt approximately twice as intensely as equivalent gains. So the pain of losing $200 is psychologically greater than the pleasure of gaining 200. So this is really common in anything to do with trade, even poker. If you're up a certain amount, even if you lose the chips that you've gained and you're back at break even, it will feel like you have lost more than what you started with. That's that concept coming into play. And then lastly, I find this super interesting. Diminishing sensitivity occurs in the markets as well. So each additional dollar of gain feels less significant than the last, and each additional dollar of loss feels less devastating than the first. The curve flattens at the extreme. So the more that you're losing, you actually don't feel like losing. It doesn't hit as much. You've already lost so much, so who cares? And that's why you get on tilt mode and blow your accounts. The inverse works for profit too. So the more that you're making, greed kicks in and you're not feeling the same. You're not feeling as euphoric as that first trade that hit, that first payout that you got. This doesn't feel that great anymore. I already withdrew 500, so what's 600? Like, this isn't that much. Let's break this down into a chart, right? So let's say we have our reference point, joy is in green and pain is in red. So you'll find that the sharpest amounts of pain and joy that we receive is actually when we're closest to our reference point. Now, the further we get from that reference point, we do have substantially more of that feeling, so more joy coming in, but it's increasing at marginally smaller amounts. So obviously, if you're making a crazy amount of money here, your joy is going to be higher than if you've made this amount. You'll notice that the difference from this amount to this amount is actually quite marginal. And it's crazy because so many times I've been in this position here, chasing this, thinking that it's going to give me a lot more euphoria. I get to about here, doesn't feel that different, and all of a sudden I'm running here. And as soon as you get from here to here, that's why you go on tilt mode, because each loss feels less and less like a loss. You're just fighting to get back to where you were here. Crazy. The good thing is, and getting into the why and the mechanism of why you feel that way, is that it's actually not a mindset problem. Deep down, if you don't work on it, it is, but it's actually wiring. We as human beings, this is our inherent nature. Tom, Fox, Treble, and Poldrack in 2007 did a study, and they put people in an fMRI scanner and made them take financial bets. The results were unambiguous, which basically means that it wasn't just for a select few. This was universal across all participants. So the striatum, the anterior insula, and the prefrontal cortex, specific regions of the brain, all fired up when they were making these bets. Now, the striatum was most active in the threat response. So when people were losing, this system was triggering and firing a lot more. Anterior insula was also firing as well. So this drives that avoidance, that feeling of I can't lose, I don't want to lose. And then your prefrontal cortex, I find this super interesting. They've done studies outside of the financial sector on the prefrontal cortex, and people that have damaged this area due to traumatic brain injury actually sometimes come out with completely different personalities. It has the potential to change you that much. And so if your striatum, your anterior insula, all these areas are firing, you don't have as much oxygen and blood going into this region that's going to be in charge of your decision making. So keeping that in mind and understanding what's happening on a sort of neurological level helps you to recognize that you are just human. You don't need to beat yourself up when you're getting into this stage. There's nothing wrong with you. You don't need to be fixed. You're not a loser. It's just your brain is doing what it's meant to do. And it's done this for hundreds of years to keep you safe. There's an incredible psychological trader that talks about this. He's Randy, I can't remember his last name, but he does some incredible videos about the animal brain and why we're wired like this. This has served us really well in keeping our species for as long and as alive as it has. Personally, I'm religious, so I believe there's a deeper level that goes towards that, but a whole other can of worms for another time. Let's keep going on this topic though. So basically, what does this look like in your challenge? So if you're funded, if you're taking a combine, how does this actually manifest in these brain regions? So when they're all fired up, you have your freeze response, the revenge trade, and also the disposition effect, all compounding and happening at once. So obviously you have the freeze, so as your drawdown approaches the limit, the threat response activates. You stop taking your setups, not out of discipline, but out of neurological aversion. It's not even what's on the charts, it's the fact that your brain is feeling some type of way and you want it to stop feeling that way. That's why you take the trades. Obviously, the pain of the loss triggers the opposite. So you're getting that risk-seeking behavior now to get that money back fast. Again, it's not recklessness. It's a neurologically predictable escape attempt. You're just trying to help yourself. That's all that you're doing when you're doing these things. And reframing your mind to see it like that is super important. Again, the disposition effect. You cut your winners short and you hold your losers too long. So you got a negative risk reward. Odin in 1998 actually found this, and they proved this with 10,000 real accounts for people that actually knew how to trade. So they found that 68% of traders were more likely to sell their winners early, and they were more likely to hold on to their losing positions. Now, the net result of that is your edge is cooked. Even if you know how to trade, even if you get it a lot of the time, if you're making these errors of cutting your winners and holding on to your losers, your edge is destroyed. You've got a negative risk reward, unfortunately, and you're not making money in anything, really. I mean, output at work, in poker. There's so many examples of this, of doing the opposite. And the best thing is all you need to do is inverse and flip these things. So hold on to your winners just that little bit longer and cut your losers that little bit faster. And that's slowly over time. So really cool study here. I encourage checking this one out as well. So the crazy thing, let's shift it back into the prop firm space now. So how do prop firms exploit this? So all of these 4 targets that prop firms have, or rules, or whatever you want to call them, all tie into firing that response, that threat emergency response side of your brain. So maximum daily drawdown, your total account drawdown limits, all of these are a reference point that's already set for you. So you are going to determine yourself a winner or a loser if these targets are hit. I think that's really important to recognize that there's already a reference point at play as soon as you open up your trading accounts. Next is the profit target, obviously in the opposite direction now. And before I could pass combines, I'm embarrassed to admit that so many times I would get so close, a couple $100 away from passing, and I'd blow the entire thing. It's because you have that reference point that tells you whether you're a winner or you're a loser by that amount, which is really impacting, again, all of those parts and functions of your brain that are firing to achieve that. And last, the consistency rules. So this punishes natural performance variance. One good day becomes a ceiling, and the psychological ceiling inverts rational position sizing. You have a really good day, that's a great thing. And in a prop firm with consistency rules in place, all of a sudden now that's a negative thing. It's another thing that you have to overcome. We know that they can be pretty predatory, but I think if we hold on to this, that your pain is not caused by the loss. It's caused by the distance between where you are and your reference point. So change the reference point and you change the emotional experience of the exact same outcome. Here's an example. So if your reference point is being green in this morning's open compared to your edge's expected value, if you're down $200 from the open with this reference point, all of a sudden you're losing, which then leads to fear kicking in. You want to make back your losses, you're trading, and irrational decisions start occurring. And it's just a downhill slope from there. But if my reference point is, I'm just going to trade the edge's expected value and I'm down 200, it's within my normal variance. Process is intact. I'm going to continue executing the same trade. It's interesting because if we hold this reference point and we trade our strategy and it loses, inevitably that must mean that the strategy that we're employing isn't helping us achieve our goal of where our reference point is. And that's why you're changing your strategy. That's why you're hopping. That's why you're not trading risk to reward anymore. You're just trying to get your loss back. It's important to keep our reference points in a healthy spot. It's going to help us keep moving forward with consistency as well over time, over a long period of time, not just 1 or 2 or 3 trades. So here are some things that you can apply right now if you're in the prop firms. Number 1 is to size so your drawdown limit is almost unreachable. So if your max daily loss is 500 and you're risking $50 per trade, you need 10 consecutive full losses to breach it. Now that's almost impossible if you know what you're doing. With a coin flip 50-50, price can go either up or low. Obviously with liquidity sweeps and whatnot, it can be a lot harder than just that. But if you know how to trade, you can read a chart. Keeping your risk the same per trade is really just step 1. Sharon and Statman found in 1985, position sizing is the single most effective structural intervention against loss aversion driven behavior. So if you want to stop going on tilt, a good idea is to reduce the position sizing. And I did get that comment in my last video, so I do appreciate that comment from you, my man. I forgot your name, I apologize, but you know who you are, and I appreciate that. Next is to hide your P&L during the trading session. So your P&L is a real-time reference point update. Every time you look at it, your brain recalculates whether you're gaining or losing. And so hiding it during the session removes that trigger. Tom et al. In 2007 found that reduced exposure to lost framed information reduces the threat system activation. That's really important. If you can just hide where that reference point is, you're not going to have the fluctuations of I'm doing really well or I'm doing really bad, which again preserves that mental capital. And then last, reframe the reference point before you start. So before the session, write down what a normal losing day looks like within your strategy's historical distribution. So back test, understand how this plays out over time. If your system loses 3 out of 5 days, but is profitable, a loss today is expected, not a threat. And that's really important, having that reference point changed and framed in a healthy way. So gone over, losing 200 feels worse than winning 200 feels good because your brain is wired that way. This is prospect theory. It's been replicated across cultures, decades, and now brain scans. Be kind to yourself. Like, this is something that is not uncommon to us all that are trying to do this. Trading is already hard. 90% lose. The 10% that are profitable, again, are because they understand how their brain is wired and what they can do to protect against it. Your challenge structure is built to activate the response at maximum intensity. So now, relating to prop firms, it's heightened once again because we have all of these drawdown limits, profit targets, consistency, trailing drawdown, all of these things that are going to impact and heighten those responses too. And lastly, the solution is not to feel less. It's to change the structural conditions so the trigger is never pulled in the first place. It's hard to fire a gun if there's no bullets in there. So if we can remove all the bullets that are going to make us blow up our accounts, it makes it harder and harder to do. So I just want to end with something that my psychologist said to me one time, relating back to being kind to yourself, is that I see trading as we're on a really long journey. We're not going to get there in a week. We're not going to get there even in a year. It's going to take years. So it's a long journey, and you relate that to someone with a donkey, right? He's trying to get from this location to this location, and it's a long journey. So he's going to use this donkey. He's got two ways that he can treat this donkey. He can either beat the donkey with a stick and really drive it hard into the ground and say, "Hurry up, donkey. Oh, you stupid donkey. You're so late. Hurry up, just get there." Or you can treat it with kindness. You can treat it with empathy and say, "Yep, I understand you're trying really hard, mate. It's a long way to go. You slipped up. It's all right. Let's get back up and let's keep going so that we can get to our final destination." A donkey is your brain a lot of the time. We're on this for the long haul, and the more negative we can be towards ourselves and even to the others around us, the less likely we're actually going to achieve our goals. So next episode, we're going to talk about your brain running out of willpower, ego depletion, and decision fatigue in trading. Here's a list of the studies that we've just used to create this presentation today. If you did get anything out of it, please feel free to leave me a comment, subscribe if you feel inclined to. But most importantly, you could be doing anything right now and you chose to give your time to this video. So for that, I'm truly grateful. I really appreciate your time, and looking forward to tuning in with you guys on the next episode. I'm going to be trading live every day at 3 p.m. New York Eastern Standard Time. Come hang out, come play some chess, come make some beats, and all the best for the rest of your trading. God bless. Take care. Peace.